Yeah, it's what 6:30 in the morning, and we're already about 12 hours into our week. Your week better not be starting. That happened quite a while ago. Yeah, the markets open in Asia. Remember that? Anyways, hey, welcome to QuantBox Live, where we get our global macro on, uncover the best fundamental opportunities across our global markets. We're going to look at all kinds of things: sentiment, inflation, employment, GDP, yeah. We also want to see if we have an underlying intrinsic trend. We want to look at the change in capital flows, but also capital stocks this week and throughout the next, I don't know, dozens of weeks. This page is going to change a lot with central banks and their staff providing us projections. Just a lot to do. What can I say? A lot to do. We're probably at tops and bottoms of many markets. So if you're watching this on YouTube, why don't you visit quantbox.co and give it a test drive? It's not a lot of money, but it could radically change the way you go about trading. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money cannot afford to lose. Let's log into the pro. Do, 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 do. 4.22. That's an improvement over the week. In fact, why don't we do that? We don't usually start this way, but we can. What's changed over the last 7 trading days? Well, the Japanese stock market is way, way, way up, but on Friday came down 1%. NASDAQ way up, FTSE way up, S&P 500 way up, Dow way up. I don't know, maybe buying some some stocks last week. Yeah, seems so, huh? Hmm. The Council of Investment Advisors bought some of this. Very cool. DAX lagging, but still positive. Yen weak, Swissy weak. Yen weak, Swissy weak. Swissy weak. Swissy weak. Yen weak. Swissy weak. Yen weak. Yeah, it could be with some dollar strength, could even be a carry trade if we look at USD Swiss franc, huh? Wonder if that will come along. So the dollar's been weak, but I wonder if it's going to roll over and be strong. Switzerland cut interest rates. They were the first of the majors to cut interest rates. Yields on the 10-year T note are down 2%, so that's good. Weak yen, weak Swissy, that's usually good. Okay. Oil flat for the week, but there was quite a bit of volatility, huh? Up and down. Gold just sort of flat, really. Mhm. So this USD Swiss franc is what we see here. I'm just wondering if this will end up if the Fed's not going to cut for 3 months, maybe the dollar remains strong. Switzerland's already cut, so there's a difference in regime. So, this one might be interesting to watch for a while. Okay, remember USD Japanese yen has got much bigger resistance levels than that one. Going back to the dashboard here, oil's up. As you know, Saudi Arabia and OPEC have continued their cuts in production, even though the first series of cuts actually led to increase in production. So I guess it's really more of a try again. But the risk is always on the side of pushing oil up, and that's geopolitical risk. Like the Ukrainian army sending in drones to attack Russian oil, right? Yeah, that kind of stuff. Tensions in the Middle East, tensions in shipping could even do it. So there was a Chinese ship that was attacked by the Houthi mamas, and so there's that kind of stuff. But also, China's trying to get their economy back up. They're trying to hit 5%. There's a 6% increase in demand for oil from China this year over last year. So, there could be a demand side. If central banks start cutting, that's a form of stimulus, which could create increases in GDP, which would be increases in oil. So, anyways, for quite some time, I've been bullish on oil, and all of that narrative is still there. But we also now have seasonality. Okay, and seasonality kicks in. So you have a seasonality tool, you might want to use it. I'm not saying, I'm just saying. Okay, a little bit on gold, S&P 500. It's the big question is, did we top out? Did we top out? We'll find out. We'll look at that. Closer to 108 now on euro dollar, showing a little bit of dollar strength over the last several sessions. Okay, Bitcoin dropped back down from, if my memory serves correctly, we were at 68 in the middle of last week, and then it dropped down to about 64, and now we're at 67. Oh, interesting. Yeah, it's an interesting asset. I held that for like, I don't even think it was a day last week. Not even a day, and it had moved 10%. Like, not in a day. Uh and then I got out and it crashed. Like, wowzer, you gotta be, it's like walking on eggshells with that one. So some time has gone by. We had the Fed meeting and the response to the Fed meeting, and then all that kind of stuff. And with that water under the bridge, there's no underlying intrinsic trend. There's no correlation amongst assets. So you need to be careful. So you don't do things like sell the dollar, sell the yen, sell the Swissy. Uh, that usually works, but that correlation amongst these assets doesn't exist. So now you might want to find cross pairs, or if you see setups, they're very particular setups, and maybe p- for um, for or against one particular currency or one particular cross pair, or you are buying or selling gold just because it's offering you a technical pattern, but nothing else exists. You can't say, well, that is bearish, so this is bearish or bullish. That no, 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 no. So you just have one-off trades, what I call shooting at rabbits. So that's the facts, right? Jack. That's the fact, Jack. So be careful. You probably are not going to be able to build a basket of trades. Okay. So please be careful. So what is going on? Bitcoin's up. That's it. Japanese stock market down 1%. That okay? That's a bit. That's a doozy. FTSE down a bit, but Japanese stock market, wowzer. Okay. Notice the Japanese stock market pretty soon typically has a little drop before flattening out for the summer. This April to May period, which we're coming into soon, is not good for the Nikkei. So if you have a bigger chart than this, you might you might see a top, for example, and you might want to I don't know, give it some weight in your analysis. You can see from here to here, it looks like a steep climb and then it flattens, which shows you that the uptrend, at least in this period, is slowing down. And then we also know that today it's already down a lot compared to other assets. So we already have this tick down, which would then flatten this slope even more. Okay, nothing else is going on yet. Okay, nothing is going on yet. Japanese stock market way down, Bitcoin way up. And as far as currencies are concerned, lots of pullbacks. This is how you read this. Lots of pullbacks. So, what I've taught you in the past, and I hope you're picking up these things now quickly. Uh, the slope looks something like that, right? Or even like this, but you have to incorporate. So maybe, um, but all that is just not good at the moment. Okay, you want the slope to look more like this. This is expected. This is unexpected. Okay, it looks like most things are somewhat up, but they're not the right things. So be careful. Maybe the maybe you'll be selling these later today. I don't know. Be careful because once again, we don't have a clear underlying trend. There's no real reason for people to be trading right now. Maybe things will change. I don't know. Let's take a look at the calendar. And today there is news. Maybe it's not incredibly market moving news, but we have real estate news. I believe it's at 10 a.m., but it's not market shaking. But the thing is, we want to see if we have demand coming back with mortgages being below 7%. Now, they're still high, but the thing is, this is buying season. April and May is when you have to buy a new house because then you close by June, school is over, and then during the summer you move your kids into the new house and you get settled and you got to get ready for August, September school starting. So this is when you buy a home. If mortgages had been more reasonable, we would have sold a million more homes in the last year. A million people would have bought a new home in the last 12 months, but didn't. So if mortgages are down even somewhat, they can buy the house now, move, and then in a couple of years refi and get a better deal. So now they're like, okay, we'll bite the bullet, we'll buy the house, we'll pay too much for a couple of years, and then we'll refi. So you want to look at that. Now, if you buy an existing home, guess what? Home Depot and Lowe's stocks go up. Yeah, that's the reality. See, when young people got married and started a family and they bought their first, all that kind of stuff, people would give gifts at the wedding or at the baby shower, and they're like, "Oh, here's a baby or baby or us gift card," or "Oh, we got you at the Crate and Barrel." What was it? Anyways, you buy somebody dishes. Now you give them Home Depot cards. You're like, you're starting a family, you're spending all your money at home, and weekends at Home Depot. Yeah. So anyways, if that comes back, there you go. That's how you might want to play that out. Friday is not a great Friday, but it's good. Okay. It's not a great Friday for trading because most of the markets are closed around the world. But for some reason, the government wants to give you the most important measure of inflation on the day the markets are closed. So there you go. It's a it's the greatest Catholic holiday of the year. Yes. Anyways, so there's that. So be ready. Okay, there won't be live streams going on. There won't be coaching going on. The market's closed. If you want to do something, if you're itchy to do something about markets, go through a training course, right? Yeah. Thursday's quite busy. Pending home sales. Once again, another real estate kind of thing. Um, because maybe look at it this way. We know GDP is C, okay, plus I plus G. Okay. Okay. We know those are the major components. And like this is the economy for Cuba and North Korea, for example. They're closed economies. Uh, if you're an open economy, you got to do X minus M, which is imports minus exports. Okay. But the point that I'm trying to make here is when you're measuring the health of the consumer, and remember this, that equals 70% of the US economy. What we're looking at now is, do they feel comfortable going shopping and spending money? I'm not so sure. My fancy pants cigar bar is going out of business, and the low class cigar bar around the corner is going out of business. And I asked them what's going on. They're like, just it was great a year ago, and it's not great now. I'm like, really? I went to an Old Navy. I went to an Old Navy. It was great. I even put pictures on the internet. Clean bathrooms. They had really clean bathrooms. My wife is like, it's 9 o'clock in the morning. wait, wait till 2 in the afternoon. I'm like, I don't want to be in it. Yeah, and I'm that jerk who walks in and they're like, can I help you with anything, sir? I'm like, yeah. Why is it called Old Navy? But my point there is everything was on super sale. Everything was 50% off. Everything in the men's section was 50% off. And it was kind of a fun experience because I'm like, that shirt looks really nice. And then you touch it and you're like, oh, this is made out of the wrong material. How about this? That jacket looks really nice. And then you're like, what is this made out of? Tarps and garbage bags? Oh my God. So it's just really a strange little world. But are Americans spending money? And I'm not sure if they are. It's a little bit concerned, but that's why I like to do all this stuff as an economist. And now we're talking about today about real estate. We're talking about existing homes, which are most important because they haven't been moving. New homes have been moving. But here's the thing, that's another form of consumer. It's not a C, it's an I. But when consumers buy a house, it's an investment. I often break this out consumer and businesses because businesses don't consume, businesses, right? They invest. But consumers also invest. And when they make that choice, it's going to be real estate and stocks. So, we want to watch that with mortgages coming down and demand high and all that kind of stuff. And the idea, remember, future expectations are what matter to the market. And if market participants believe mortgages will be dramatically lower in a couple of years, well, you got to buy now. If you need to move, you're like, okay, we'll just refi. We'll just refi. Because think about this. In 2 years, if mortgages are 4% instead of closer to 8, then the people that are buying now are going to push up prices and then refi when things drop. And then the people that don't buy, well, now they can get a cheap mortgage, but the house has gone up 20%, right? So if you were going to do it now, I think when prices haven't gone up and mortgage rates are going down, have a higher cost for 2 years and then a lower cost for 28 years. All right. Okay. Some consumer confidence. Great. Australian CPI Tuesday night. All right. We're interested in, are they going from hawkish to dovish? Look at, right, expectations, inflation going up. That's hawkish, huh? How could Australia cut interest rates if inflation's going up? Okay. And not just up, like some parts of the world, it's going from 2.8 to 2.9, for example. Um, well, Australia is going from 3.4 to 3.5. So they're already on an absolute level higher than most and expecting to go up, not down. So kind of hard to cut. The conversation on the street is twofold. As foreign exchange traders, which central banks are going to cut first? Like, what order are they going to cut? Switzerland made the first move. You'd look at Australia and say they're probably a last mover. QuantBox plots this all out for you, by the way. I mean, why don't we do that now and then I'll come back to the COT. Okay, so you could say, let's look at the RBA and it's pause and not till the third quarter is there a cut, but when in the third quarter? November, December? Okay. Canada, okay, once again, third quarter, but when in the third quarter? So it's hard to break them down, right? Because these are 3-month periods. Okay. And look at Switzerland. Yeah. Europe. Okay. This is still being plotted as no cut, no cut, no cut, no cut. And then what is that? Second quarter 2025? Really? Well, I guess that's what they told us. Okay. So the way that you read this is Japan is the most hawkish, and there and wait. No, dovish. Sorry. Mm, mm, mm. Okay, so these currencies are already being cut. This is the weird one, right? Because they're raising. Wait, maybe I have this. Hang on, it's Monday. Hang on. Hang on. Hang on. What do we know? Okay, this when you're given puzzles, right? You have to organize your thoughts. What do we know? This is a puzzle. What do we know? The United States is going to cut interest rates. They're telling us 3 times. This is all based on what they're telling us, and we know Japan is going to cut or they've raised to zero, and this is showing actually one or two more hikes actually. Okay, based on what they're telling us. And remember, we get this data from the OECD, which gets the data from the central bank itself. So this is not like Wayne's opinion. Okay, so the question then is when will the Fed cut? So these are cuts in play. Canada is expected to cut even more. So they're dovish. Less dovish is Australia. They're going to cut less. And then so we have to say why. Well, they have higher inflation, right? And so either slower or less cuts. So Canada expected to cut more, and Japan expected to raise. Okay. Quite unique, huh? Compared to everybody else. So going back to Canada, okay, they will start cutting soon, it looks like. Okay. In Switzerland, it's sort of a one and done. This shows Japan steadily, but very slowly. Like it's steady and it's steep, but by very, very, very small amounts, right? We're talking about maybe, I mean, less than 1% in about 2 years. Oops, it's stuck on that. Anyways, there we go. Okay, third quarter, there's a right. A lot of these central banks are talking third quarter cuts. Okay, you see them coming in. Mm, 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 mm. So you want to know when they cut and how fast. And so that's what we're trying to figure out with these charts. And again, we're getting this data from the data they are providing us. Okay. The second thing, so that's the first thing that the market's trying to figure out, the order of the cuts. And then the second thing the market's trying to figure out right now is the neutral rate in the United States. The Fed has told us that they think it's 2.5, 2.6, but definitely less than 3 by a lot. And therefore, the Fed looks at the neutral rate at 2.5, and they're nearly double that with interest rates. So that's extremely restrictive, extremely restrictive. So Powell was saying that they know there's inflation and inflation's going up, but they're looking through it and they're like, well, we're still going to cut because we're so restrictive, not because the market needs to be saved. They're just overly restricted. Okay, fine. But then you have Larry Summers, who is an economist, past Harvard president, and past treasurer, right, for the United States government. And he says, no, 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 no. It's not to something, it's for something. And therefore, the Fed is barely restrictive and that they should do nothing. They shouldn't cut at all. Okay. So that's the big debate amongst institutional investors. Maybe it's not for something and maybe it's not to something. So if the Fed cuts, is there 3 cuts? Is there 5 cuts? Or what's right? And then what would happen if the Fed or when the Fed does cut? So that's what's going down. And that's for you to try to figure out too. All right, let's take a look at the stock of investments. This is a screenshot, like a balance sheet. Okay. of investments in the United States. The market is long oil, gold, silver, and Japanese stock market. And it's short the Aussie, the yen, and the Swissy, and the yields, which makes me happy. I'm short the yield. Cool, cool. So that's good, right? That's the stock, the amount, the balance. Right? So contracts long, contracts short. Obviously the Australian dollar is very bearish in the eyes of institutional investors. Okay. Now we want to look at the flow. What did investors do this week? Because this is over long periods of time, the accumulation of assets. Okay. So now what's happened week over week? So you do that, the net change, and that's cash flow. And if we do it in reverse, investors are dumping the South African rand. Okay, why? Probably because the dollar is strong. Okay. And in that case, exotic currencies get punished if the dollar gets strong. So they attracted some investors, but double that were actually shorting the rand. Okay. And pretty heavy volume. Okay. Pretty heavy volume here. So a giant increase in buying the South African rand, but almost a 300% increase in pairs. So for some reason, a lot of, you know, investment went into the rand last week. Doubling of the longs, but tripling of the shorts. That's pretty significant. But 50-50 as a market, and dollars also 50-50 USD. But is there a change? Okay. Well, we've lost some bulls and we gained some bears. So maybe that leads to some weakness. But right now, really, it's neutral, right? Thing is it moving left or is it moving right? That's what you need to be figuring out. And that's how you make your money. But remember, we already looked at our short, medium, and long-term gauges, and they said there's no trend with the dollar. And then we look at the stock of dollar. Who's leading the way? The bulls or the bears? Nobody. It's neutral. That's why there's no trend. So be careful, huh? Meanwhile, the Japanese stock market has been very bullish. We've lost some bulls and we've added some bears. Really, no big deal, uh, but not bullish. And we'll see what goes on there. Is this losing favor? Has the policy change at the Bank of Japan changed these things? Remember, they killed what they call yield curve control, and then they said, but they'll continue to buy treasuries. And I'm like, wait, what? That 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 was what you were doing with yield curve control. Yeah, but we're not going to call it yield curve control. So, anyways, great, right? So a radical departure, maybe, right? But there is a regime change there. It's different now, and so maybe that will, over time, impact the attractiveness of buying the Japanese stock market. But they are going to remain accommodative. That's what they have told us. Okay. Losing money in Kiwi, Euro, Oz. So we were talking about Aussie, 80% short. Okay. A significant decline in bulls and a significant increase in bears, what they call bloodbath. Okay. So, do you wake up in the morning and sell the Aussie? That's what this information's for. Money is coming out of these assets. But this one started bearish and got more bearish. Big difference, right? See, this market's 50-50, this market's 50-50. This market's significantly bullish, but bearish. So you're like, well, okay, it's bullish, but it's a bearish week. So maybe it's just a buy of the dip. And this one's 50-50, and this one's kind of almost 60-40, but so it makes the change sort of neither here nor there. But when the market is already 79% short and getting shorter, that's the one that makes you feel tingly inside. Look on the bullish side, Dow's 73% long and got longer. Not only are there more bulls, there are less bears. An increase of 18% in bullish contracts, okay, and a decrease of 9% in bearish contracts. So more long, less short, positive change. Stock market up, NASDAQ. It's now 50-50. Big difference between um, NASDAQ and Dow. Why? Aren't they kind of the same thing, market forces? No, this is actually portfolio management. And this is what I'm teaching at the CIA, the Council of Investment Advisors, that in circumstances that we face now, which are market tops, the way that institutional investors manage their risk is not to dump the stock market that they've spent 5 to 10 years building a portfolio in. You don't do that. You manage the risk. You either hedge it or you rotate from higher risk. So in this case, NASDAQ has a high beta. When things are good, it moves the most. When things are bad, it moves the most against you. So if you're now worried we're at a top, you're like, man, I've killed it in NASDAQ. You're like, man, the last 2 years, I've made a ton of money on NASDAQ. But now you're worried? Rotate money out of NASDAQ and into the Dow. So if there is a 10% decline in the stock market this year, NASDAQ could drop 20. And the theory is Dow only drops 5. So you have a beta of 0.5 against the S&P 500 and a beta of 2 versus the S&P 500, right? So Dow drops 5%, S&P drops 10%, NASDAQ drops 20. Okay, that's the logic. And so you would rotate, take money out of your NASDAQ investments and buy Dow. And it's just an amazing coincidence that everyone's facing the same macro risk, and you just happen to see the exact thing that I teach in portfolio construction. So that seems textbook. Okay. Straight out of Harvard. Yeah. Taking a look at silver. A lot of interest up. Now, if you believe inflation is coming back, and we've had 2 months in a row of inflation rising, and Jay Powell says he's just going to look through it. So he's not going to do anything about the inflation. So when you see inflation, what do? You buy commodities. Silver and oil and gold and platinum all fall in there. But also like wheat, it's another one like, yeah. See, what happens is when you have outrageous inflation, What do you spend all your money on? Financial assets or food? Food is a pretty high priority for you and your family, huh? So you end up spending the money there first. Food and shelter, food and shelter. So I don't know, your Amazon stock, would you sell your Amazon stock so that you had the cash to pay triple to buy a bag of rice? Suddenly, instead of a bag of rice being 10 bucks, it's 50 bucks. Well, sell that Amazon stock so you can get the 50 bucks because you want to feed your children. So if you think about it in that extreme way, when inflation is rising, very often what you'll have is the financial assets will come down and the commodity assets will go up. And we're on that precipice of maybe that shows up. I don't know. You have to make those decisions. So then you're like, well, are other people thinking that way? This is how you use the tool. Are other people thinking that way? And you could start tracking if or when does money start going into things like silver and oil and platinum. Okay. When are those things going to start going up? And you might even want to look at things like food uh, contracts, food commodity futures contracts, as well as these financial assets, huh? Okay. See, money is coming out of the SPX, 21,000 contracts less long. We lost 21,000 bulls and we lost 61,000 bears. So the stock market goes up, right? But it's an illusion. This is why you have to have data. I really want you to think on this. The stock market went up, so people bought it, right? No, nobody bought it. Not one living soul. Less bulls, less bears. But because there was significantly less bears, it looks like it's going up. It went up 1%. Nobody bought it. Everybody sold it. There's just less buyers and even less sellers. So it's becoming more and more neutral. Very interesting stuff. And we can see it. Okay. Euro dollar looks like it's turning bearish. What do you think? Technically, this is only technical analysis. And on the daily, so going from March to March, this is almost an entire month. This is about 3 weeks. Back on March 14th, we dropped below the moving average, indicating possible bearishness. Going to March 21st, we did not make a higher high. People did not buy the dip. It did not go higher. And instead, you start connecting the high dots, right? Okay, but that's what the moving average is doing, is smoothing out everything, and is now technically bearish. And the best case scenario for bears is we're on our way from 108 and some change down to 107 and some change. So this is a 7-day projection. So by the end of the month, 107 ish. What do you think? Smell like a plan? So now you can go to your charts and say, well, maybe you want to be bearish. Well, it's neutral, but technically bearish. Maybe the fundamentals will change, but they change more slowly. They change based on economic data and central bank policy. But definitely, this is technically bearish. Okay. going at the yen is kind of interesting because 152 is a psychological level. So we haven't been able to get anywhere even near it until the change of the central bank policy. So March 14th, this went bullish again, technically. We got above 151 and a half. 152 is ridiculously important. And there is a ton of resistance going back years. But if you were just quote unquote, just a technician, well, you're like, okay, all that might be fine and dandy, but this is bullish. Okay. And projecting that we're not only through 158, best case scenario, of course, not only are we through 152, but we're going to get to 154 in a weeks of trading, not but well, let's say by the 31st. Okay. Wowzer, huh? Base case, we get above 152 ish. So closer to 153. Remember, 152 is impossible level of resistance. There's got to be a ginormous amount of stop losses above 152. A bajillion. So I think if we're actually going to breach 152, so I think we'll tiptoe through the the minefield, and then so we go to 151.80, 151.90, 152, boom, 154. I think I think the first 80 pips are going to take most of the week, and then the next 250 pips are going to take hours, not days, because we'll just be taking out all those stops. So this is definitely one to watch. Very interesting. How about that oil? QuantBox is it very bullish when you look at all the economic data. It's very choppy when it comes to the technicals, but okay, well, still with all the vol, we smoothed it out with the moving average, and it's bullish. Okay, price came up, it retraced, and if the technical trend continues, okay, because we measure the slope of the mean average, you can do a linear projection with standard deviation, and you get as high as 84.50 in a very bullish move, 83, or there's going to be a drop to 79 and then a recovery back to 81. All of those plausible based on standard deviation. But if you're going to filter that a little bit with your bias, if you're bullish, you're going to you're going to be in the upper half. Okay. So you're like, okay, so we're going to take it this week from 81 to as high as 84, 85. Okay. Take a look at, I guess we'll take a look at SP 500. To me, it represents the beta because I see it as a mix of both value and growth stocks. And we want to look at it, and it is still technically bullish, economically neutral, but technically bullish. So, really, one way to look at this is if this changes below this moving average, it could be very significant, meaning in terms of potential losses. So let's say a 10 to 15% decline in the US stock market. Um, but the way that the stock market tends to behave is you take the stairs up to the top of the building and then you take the elevator down is the polite way of saying it. Other people say you take the stairs up and you jump off the top of the building. Nonetheless, the decline is faster and quite unpleasant, especially if you choose the second option of retracement. So anyways, this is not bullish, or sorry, not bearish. That's how I look at the stock market. I'm concerned about the stock market, but I own it. And as long as it's not bearish, you have this this I don't know, this built-in support, because 99.5% of the market makes money when the stock market goes up. So nobody, statistically speaking, nobody enjoys it when the stock market falls down. Yes, you might get a couple of hedge fund managers that shorted, but don't worry, many of them haven't. So, yes, a handful of people will make an extraordinary amount of money because they're so smart, so flexible, and so leveraged. Okay, great. Good for them. Nobody else makes money. So, the stock market does not want to fall. So, when it shows signs of bearishness, yeah, you need to pay attention. Is it bearish now? No, it has a positive slope. So cool. Okay, cool. Cool, cool, cool. So go with the flow. Let's take a look at some gold and look at how beautiful this trend is. But I'm more bullish on this asset than I have been in years. And I'm so glad to see QuantBox agreeing. But the technical analysis, and this, by the way, is the daily chart, the smooth one. If you're on an hourly chart or a 15-minute chart, you're like, you made money on Wednesday, and you lost money on Thursday, you know. Wow. So be careful. Um, at least recognize that this is worthy I don't know. That you don't have the trend that you would expect, at least even on this daily chart, right? So I would connect these ranges, and so maybe you buy at the bottom, because I'd be a bull, and QuantBox is a bull. And I did turn a bull. It might have been actually this period here. It's in QuantBox in the back tester, but anyway, so when you're in a range and you're a bull, you buy the bottom. So there is a reasonable chance, according to standard deviation. Okay, using standard deviation. I'm trying to get a different blue here. Um, that you might get one of these this week. Yet another buy a dip scenario, but bullish. Or you get lucky, and last week's March 22nd buy has some variation of this, and eventually a breakout. But you have to be able to survive the vol, so you got to buy at the right place. Dan the man says, does the Japanese stock market predict the direction of yen pairs? Historically, yes. If the Japanese stock market goes up, you're selling the Japanese yen. Historically, if the Japanese stock market is falling, you're buying the Japanese yen. Okay. So if you see the Japanese 225, the Nikkei, falling today, you would sell yen pairs. In particular, you'd probably sell Aussie yen, or right, or Kiwi yen. Okay. Okay, so I think that's enough. I think that's enough. That was just yeah, that's enough. About an hour. Yep, I think that's enough. So I will see you later today at Forex today, I am sure. And then day traders, I will see you at 4 p.m. at the market close to set up Tuesday. Nonetheless, I'm always here for you. Email me, Wayne at fxbootcamp.com, if you need anything, if you have a request, a thought, comment, all that kind of stuff. You are not alone. Peace on earth. May the pips be with you. May your profits be above average. I'll see you when I see you.